Well, Tom Lee is at it again, doing what he does best, and that is telling us what he thinks is going to happen for 2025, and you guys are going to be shocked when you find out what Tom Lee had to say this time. Don't worry about subscribing, tapping the like button, or looking for the coaching and Discord link. We will get to that, I promise. Let's strap in and listen to what Tom Lee has got to say.
Is the market now free of the indecisive December choppiness that dropped the average stock by more than 6%? And what are the crucial catalysts to watch from here as January unfolds? Here to take on those questions is Fundstrat's Tom Lee, a CNBC contributor, of course. Tom, good to see you. Happy New Year.
Happy New Year to you.
So first off, Tom, what's your diagnosis of what the market's been contending with here in the last several weeks as we've gone sideways and had sort of this negative skew toward market breadth?
Markets kind of did flail into the end of last year and the first day of 2025, and I think it was trying to digest a few things, that the pretty dramatic move in long-term yields and the dramatic drop in yields in China. I think that there has been some concerns about macro as you saw some events over the past few days. And I think there was general profit taking and some sort of let's wait and see how 2025 is, given we just booked two 20% back-to-back years.
And do you think that those things will remain overhangs? I mean, obviously, you certainly have a bullish orientation. You feel as if the S&P 500 can get to 7,000 by mid-year before perhaps a pullback. Well, if we're getting from here to 7,000 in less than 6 months, you're talking about, 35% annualized pace of gain. So how do we get there?
Well, I think one thing the viewers need to keep in mind is that just because the calendar year changed doesn't mean that the strength that we saw throughout 2024 suddenly has evaporated. There are tailwinds building because the Fed is dovish, even if they're making fewer cuts. But I think one of the sort of two important things happening early in 2025 is going to be, one, we are seeing manufacturing recover. The ISM manufacturing, posted one of the highest readings in almost 2.5 years. I mean, it's been below 50 basically for nearly 3 years. And the second is that I think the labor market could be softening in a way, because whether you look at link-up data or the ISM employment, to tell us that the Fed now has to be focused back on supporting the economy. So I think this month could be quite decisive in the sense that we've got weakness because of some insecurities building, but I think it's, the same tailwinds are in place. I mean, I think it's still a buy-the-dip kind of market.
And in terms of perhaps the same themes being in place, does that mean that the leadership profile of the market you expect to stay similar to 2024? I mean, I know it's waxed and waned between mega cap growth leadership and then some broader participation, but we did finish again with dominance by the NASDAQ 100 type stocks.
Investors still are going to pay for earnings visibility, and that's why I think the Mag 7, including NVIDIA, are going to be important holdings. But financial conditions should ease this year. Easing financial conditions does allow some cyclicals to post better earnings growth, like financials and regional banks, industrials, and small caps. So I think that there should be a case for broadening of the markets this year. And then finally, I think in terms of risk appetite, still one of the good measures to look at how risk appetite is to look at something like Bitcoin, and at 97,000, it's still telling us that, this is still a risk-on market.
Yeah, I mean, obviously it's held almost all of its gains since that little poke above 100,000 in Bitcoin. Although I do wonder what you make of the relatively heavy outflow we were seeing in the BlackRock ETF that holds Bitcoin, whether it was just sort of deferred profit taking into a new tax year or something else.
It's hard to tell. And I think with the ETFs, it is creating, I think, an interesting dynamic, which is that someone who sells a BlackRock ETF doesn't have a 30-day holding period if they buy another Bitcoin ETF. So I think in some ways you can see people doing basis swaps and stepped up in tax optimization strategies and not really having to worry about that 30-day holding period.
I'm not sure if you guys caught that at the end of the video, what Tom Lee had to say, but it was very interesting. And I want to recap it now because it's kind of confusing and a lot of you guys may not have quite understood what he was alluding to when he was talking about the reason why certain types of Bitcoin or crypto-backed stocks or ETFs were going up and down and what they were doing. What he meant by that is when you sell tax loss harvesting and sell for a loss by the 31st of December, you're not allowed to buy those positions back within 30 days. It has to be 31 days or more. Otherwise, it's called a wash sale and you can't take the loss, which defeats the purpose of tax loss harvesting. So therefore, what he was basically saying is that they were switching ETFs, switching different stocks that are backed with crypto. So as an example, if you had 1,000 shares of Coinbase and you sold them all for tax loss harvesting purposes on December 31st, on January 2nd and 3rd, you would be buying MicroStrategy, or maybe you'd be buying Marathon. Those are examples. They're stocks that are heavily involved with cryptocurrency, just like Coinbase, but you sold Coinbase at a loss. Therefore, you can't buy it back until the first week of February 1st, February 2nd. So what are you going to buy? You're going to buy another stock or another ETF that is heavily involved or weighted in on crypto, which I gave you guys the example. You have Marathon and you have MicroStrategy, you have Coinbase, and there are a couple other ETFs. One of the Vanguard ETFs also track it, and there's a couple others as well. But just as an example, this is what he was explaining to tax loss harvesting. So when you have people selling stocks at a loss on December 31st, they can't buy them back until the first week of February, which is why you've seen a lot of switching going on, like Tom Lee said, and not just specific to cryptocurrency, but also other tech stocks, which is the reason why Netflix went down and Apple went up and other stocks went down and then others went up. It was kind of like a consolidation. Stocks are down, stocks are up. That's exactly what happened. Anybody that sold out of SoFi probably went to another bank for the time being, and anybody who sold out of other banks came over to SoFi. And of course, you have manipulations going on, a whole bunch of stuff, a slew of things to worry about in the stock market around tax season. One of the things I'm very interested in is Tom Lee talking about the S&P 500, the SPY, hitting $700 by the summer of 2025. Now, he did say 660 earlier on in October, I believe it was, and now it's sitting in the 700 range. If this is the case, there's over $110 in upside, meaning you can make a very hefty and large return by buying shares, selling puts, and most importantly for small accounts, buying leap option, which is what I've been explaining to you guys since the beginning. Buying leap options is very good on ETFs such as SPY, QQQ, or TQQQ. We also have the Tesla tracker ETF that's also good, but we're not going to talk about that right now, but it is another option, and there's many others besides those. MicroStrategy, Tesla, a lot of these stocks have leveraged ETFs that track them. They're very powerful, but they're also very risky. Tom Lee also talked about the economy. The Feds are dovish, and maybe they're not cutting rates as many times in 2025 as we had expected them to, but they're still cutting rates. Another thing Tom Lee talked about is PMI data and jobs. As far as services PMI and manufacturing PMI, manufacturing has been at an all-time low, and it's improved drastically on the most recent report. The economy is really doing a lot better. Inflation is also down. Feds are dovish. We have a new president-elect getting into office. Inauguration is this month, and not only that, most importantly, all of the uncertainties are off the table. Therefore, the Magnificent Seven, so to speak, in the mega caps are going to do well. Financials, as well as cyclical stocks. Now, if we're going to be talking about small cap cyclicals, I've got a list of stocks I'm going to be putting out in a video very soon to show you guys which ones I'm going to be getting into. SoFi is one that's going to benefit throughout this year. SoundHound's another. Palantir's already doing good. I like MicroStrategy and Tesla, and there's a couple others that I also really am thinking about going in on as well. This is going to be a very strong year. Tom Lee also explained that just because 2024 is over and there's some uncertainties going into the new year, people were selling off, like I said, for tax loss harvesting. They were uncertain about certain things in the economy, inauguration. You know, it doesn't change much, but people were taking profits too. And this is also the reason why stocks were selling off. People were taking profits to pay their taxes, tax returns at the end of the month. It's not really a good month historically. Everything will be okay in the stock market. Right now, it's buy the dip. Just like he said, like I've told you since the beginning, every time, buy the dip, dollar cost average. And you can dollar cost average on the way up, and you get dollar cost average on the way down. And I've explained that before as well. It doesn't matter how you look at it. 1,000 shares on SoFi at an average cost of $14.50 is still going to be more profitable and the stock goes up than 400 shares at $12. It just doesn't make sense to have a lower average, but then have less shares. If you can get more shares lower, that's good. But if you're dollar cost averaging and the price is going up, all that matters is you have more and more shares, and obviously try to keep it as low as possible, but having more and more shares as it goes up means more and more profit. This is a buy the dip opportunity. I want to show you guys an example on my chart of what actually transpired and what Tom Lee was talking about. But first, if you guys are trying to retire, maybe you're trying to retire early, or maybe you're just getting involved in the stock market and you don't even know where to begin, or you've been in for a while and you're having trouble, you're losing money, I would love to help you, fam. So what drives me every single day is helping people just like you achieve your financial goals. You guys can sign up at investorcorey.com. Link is in the information box below. You guys can sign up at any time. I offer a full training course, Discord, as well as one-on-one coaching. You can see the profits my students have been making on the screen. And if you don't believe me, let's take a listen to what my students, Josh and Adam, had to say.
For anyone who's thinking about joining, is anyone can do this. It's just really like putting in the work and the effort to meet Corey halfway, but he will definitely get you there. I started with about $300,000 portfolio. Initially saw about between 60 and 70,000 within my first 6 weeks, which I was very excited about. So now I'm really excited to share that I've grown that $300,000 portfolio to well over 500,000. I'm definitely reaping the rewards now. Don't wait. I honestly can't thank Corey enough.
So I started with 15,000, right? I am now at $40,000. Okay. And I'm so proud. It feels, amazing to be able to share this, because I know that there's so many people that will do the same, right? You have to just trust Corey and trust what he's teaching and what he's offering, because he means so well.
So you heard what Josh and Adam had to say. If you guys want to sign up, take control of your financial freedom for 2025, I would love to help you guys out. Just go to investorcorey.com, click on training, watch the video. It'll explain every question that you have, and then you'll be able to book a call with my team and I so I can help you achieve your financial goals. And I look forward to seeing you when you're ready to commit. So right here is exactly what I was talking about. Marathon came down, Coinbase came down, MicroStrategy came down, but then it went back up, and all three of them had a nice little run. Coinbase's was the smallest and MicroStrategy's was the biggest. So what's happened here, like Tom Lee was saying, is people were selling Marathon for a loss, tax loss harvesting, but they don't want to miss out on the dip. So what they did was they started selling and taking losses right here. Then they got back into MicroStrategy in this area, driving the price up. This way they could make profits for 2025. Now, this might sound a little crazy, but if you're taking a loss right here of, let's say, $5,000, well, then you move all of that money over here and you just made all that money back, meaning you saved yourself a tax payment in 2024 for 2025. And they do this every year. And instead of having to wait 30 days, this is a different stock, but it does track Bitcoin because they're using Bitcoin as a treasury asset at MicroStrategy. Same thing with Marathon. They got out, they went in and they bought up Coinbase. Same exact thing. People got out of Coinbase, and what did they do? Well, they went into Marathon. It just depends which stock they were in. They sold it and went to another crypto or heavily involved crypto ETF or stock, which is exactly what they did. So you take a $5,000 loss here, and then you quickly go over here and get in, and now you're making thousands of dollars, but you're making those thousands of dollars in 2025, and you lost those thousands of dollars in 2024, meaning you owe less in 2024, and now you made profit in 2025. And you're probably saying, Corey, that's all great, but then in 2025, you're going to owe more taxes. Well, that's right. But at the end of this year in December, they're going to do it again. So every year they're tax loss harvesting, saving on their taxes. And then immediately 3 days after New Year's, they're buying into different stocks that are similar to take profits. And this is what happens every year. That's why I try to explain to you guys the dip that happened really wasn't a bad thing. It was a buy the dip opportunity, just like Tom Lee said. I said this in my Discord and YouTube. It is a buying opportunity. You want to buy in situations like this. I sold puts on MicroStrategy at 290, 280, 270. I had some at 300, and they all printed for my Discord and myself. And this is why. It's tax loss harvesting. Things are going to progress through the month of January, and they're going to get a lot better. And as we get to the end of January, the first week of February starts to get very interesting, and 2025 is going to be very strong. And I am very confident in the economy based on the data I've been looking at and what Tom Lee and Dan Ives have been saying. The feds are dovish, interest rates are being cut, inflation is down, the 10 and 2 yields are back on the correct axis in the positive, which is good. We have a very strong economy right now in comparison to 2023 or 2022, 2021, and even 2020. We have just about as good of an economy, if not as good as we did in 2019 before the pandemic. In fact, there's certain aspects of the economy right now that are actually better than 2019. So right now, I would not worry. I would buy the dip, dollar cost average, keep some cash on the sidelines. And remember, as interest rates get cut, big institutions and hedge funds move their cash from the sidelines into the stock market. And I've explained this before. When the interest rates are 5%, of course people are going to leave big time money like institutions on the sidelines. Why would they risk their money to make small gains or medium gains when they can make decent gains sitting on the sidelines? Would you rather be in the game playing football, risking getting injured for $4 million? Or if I was the coach and I told you I could bench you and you could make $3 million to be benched, what would you do? I'm sure you'd take $2 million to be benched before taking $4 million to play, right? Half the money, like basically no risk at all. That is what cash and money market accounts and on the sidelines are. Why would I risk my millions of dollars in the stock market when I could put it on the sidelines in SPACs and FDIC insured cash sweep programs and make 5%? That is a lot. That is $50,000. A lot of money. $50,000 for every million per year and don't have to do anything to get that money. So when you're a big institution or even someone like me who has $3 or $4 million, that makes perfect sense, right? I can make about $150,000 to $200,000 a year, not even trading a single thing or even going to work. That's why big institutions and big hedge funds and big private investors have all of this money in money market. But now that the interest rates, the APY is 4%, it makes no sense not to be trading now. We're starting to get into that point where money's starting to come over. And if you think things are good right now, they're going to get a whole lot more interesting in the next 6 months to a year when the interest rates drop to 3.5% and potentially 3%. Then they're all bringing their money back in and stocks are going to fly. Don't forget, guys, you can sign up for the Discord and coaching if you guys are looking for help and mentorship and just want to improve your financial situation and reach your goals. I would love to help you. InvestWithCorey.com. Links in the information box below. And I will catch you guys on the next upload. Be sure to check out these videos that are really going to help you out. How to make $10,000 a month right now. Watch that video on SPY. You're going to love it.